It's my great pleasure to introduce Robert Engle, who is here with us live. Rob is Professor Emeritus of Finance at NYU Stern and the 2003 Nobel Prize winner in economics. Rob is speaking on climate financial risk, portfolios, and stress tests. Without further ado, I'd like to welcome Rob Engle. Over to you, Rob.
I'm going to talk about climate financial risk, and in particular with application to portfolios and stress tests. But let me start with a little bit bigger framework. Here's just a little bit of data to start with, which is we have a volatility map that we update every day of volatility measures in the equity markets primarily, but also in currency markets around the world. And green is when the volatility is low, red is when it is high. This is what it looks like now. But it doesn't always look like that. After Brexit, you can see we had a lot of red, especially in Europe, but also in a lot of the trading partners of European countries and the UK. Even more red was the map in the last March, just the beginning of the pandemic, when we saw that volatility rose dramatically in pretty much all the trading centers of the world. And so one of the things that we're interested in from a risk point of view is when there are events that are so ubiquitous that they affect all countries and typically all asset classes at the same time. This is an enormous risk for a portfolio. And there's a little picture. I mean, we might be worried about COVID, but we might have other risks that are coming along at the same time. And it's always an important thing for a risk manager to recognize there are lots of different kinds of risks, and he has to prepare, or she have to prepare for all of them. So what are the kinds of events that turn the world red in this kind of way? What are the events that shake our world in all countries and all asset classes at the same time? And a way of thinking more specifically about this is if you have a volatility model that's making forecasts of volatility everywhere, these models obviously make forecast errors. But a forecast error which is of the same direction, that is too low a volatility, in all these markets is an error which you would like to know about ahead of time. You'd like to know that these shocks may be correlated across countries and across assets. Because these are the gigantic risk events. So how can we detect them and how can we prepare for them? Well, it turns out you can develop this as a statistical question, and Susanna Campos-Martins and I have a paper which calls this kind of event a Geovol event, and we do it for countries and we do it for asset classes. And let me just show you what the results look like today. And I'm not going to show you this econometrics here, but here are the events that we think are the days which were most influential over the last 2 decades. And the biggest one was March 9th in 2020, a little more than a year ago. And this is a COVID event. But before that, we had Brexit. Before that, we had 9/11. Then there was the precursor to the financial crisis in February of 2007, and so forth down this list. And one of the things you see by looking at this list is if you're a risk manager and you don't know whether you're preparing for COVID or Brexit or terrorism, you've got a big challenge. How do you deal with events that are all unpredictable but are so different in nature? And I think this is a notion that might be called compound risk, and it faces all kinds of risk analyses. So sometimes if you're protected against one risk, you also have protection against another one, but sometimes you don't. And so the joint occurrences are important to recognize. So I'm actually going to focus primarily today on climate change risk, and this is a big topic. It's one of the most important risks over the long horizon. It might not be the most important risk in the short run, but we're all wondering how to deal with climate risk. So investors in particular are facing the dilemma: what does it mean to invest with respect to climate risk? And one answer to this question, I mean, I have actually four answers to this question here. One of which is we ought to use information, all the information we have on risks and returns, and that should include climate data and emissions data and stuff like that. That seems like a no-brainer, but in fact, it's not so true that climate data is universally used at all in figuring out risks, where risks and returns are likely to be greater or less than you expect. Secondly, you might invest with a view, this view that the climate change is underpriced, in which case you would want to invest in companies that are better prepared for climate change rather than ones which are not prepared for climate change. Some investors think investing with a view is a good idea. It could be this view is wrong, so then you don't do well. A relatively similar idea is to think of the same portfolio as a hedge against climate risk. In other words, if you go long companies that are prepared for climate change and short those that aren't, this will act as an insurance to your consumption stream and reduce its risk, because it will outperform in the state of nature where climate is really bad and underperform in the state where climate risk is not so bad. It also has the byproduct of lowering the cost of capital for companies that are preparing for climate change. So I think this is actually a fairly neutral and sensible strategy for investors who want to take a position on climate risk. But many investors actually want to go even further than that. They want to invest primarily for impact rather than for financial performance, in which case the metric of success is what's the impact rather than do you have financial performance. So if we take this hedging point of view, then what is the asset pricing implication of this? Well, first of all, firms that are exposed to climate risk should be less desirable and therefore have asset prices which are lower than ones which are not. And the reason the asset prices are lower is because unless you have higher expected returns, you're not going to hold this asset. So companies that are exposed to physical risks, like properties near the ocean, properties near wildfires, properties which are have high carbon emissions and are therefore likely to be regulated in the future, all might be in this category. So these are like sin stocks, and when they have they're less desirable because they're riskier, they have to have a higher risk premium. So this compensates investors for holding them. Bolton and Kasperzik confirm that this is, you can see this in the cross-section. So if you want to bear this risk, you can receive the risk premium. If you want to hedge this risk, you're going to short this portfolio, and you can expect to have a negative risk premium. So the CAPM alpha of a climate hedge portfolio would generally be negative. And so investors who think that they want a hedge portfolio may expect typically to have negative alphas. And portfolio managers explain to me that that's a very tough sell, that's adequate justification for taking on this kind of a portfolio. The other side of this, of course, is if there is news that the climate change is going to be more severe than was expected, this hedge portfolio will go up in value because both the long and the short sides of it will actually appreciate. So when there's little news, you might expect a negative alpha. When there is news that the climate is worse than the market expects it to be, there is an appreciation of this portfolio. And that's how it gets its positive benefit if your view is right, that the market is going to is going to price climate risk more highly than it has today. Okay, so what do we see when we look at publicly traded climate portfolios? We keep track of these on VLab, and we have almost close to 200 portfolios which are supposed to be climate hedges, where there's a lot of discussion about greenwashing and stuff like that. So we don't know whether they really are climate hedges. Their managers say they are. And if you look at the alphas of these over 1 year, 3 year, 5 year, or maximum time periods, you see for all these different categories of climate strategies, they all pretty much have negative alphas. So at least over the short run, and you see some of these sector funds have done well over somewhat longer periods, but mostly the alphas are negative. So how would you build a good portfolio? Well, I think the most common strategy is to do something which we might call fundamental analysis. That is, try to figure out which firms, by their business model, by their ESG data, by their statements of what they're going to do and so forth, are actually the green assets that are going to be prepared for climate change, and you would go long those and short others. A recent entry into this is the use of climate emission certificates, CO2 greenhouse gas emission certificates, which are now actually tradable. There's a ETF KRBN that we were involved in launching, which is pretty much a pure climate kind of trade. Not completely, but pretty much. And it's an example, I think, of doing fundamental analysis, although this does not require ESG data. And that's probably an advantage, since ESG data is easy to criticize from a lot of points of view. The alternative approach is to do statistical analysis. And the feature that we're looking for is when there's climate news, you would expect that some stocks will go up and some stocks will go down in response to this news. And you want to hold the ones that are going to go up, and you want to short the ones that are going to go down. And we have one paper in the RFS on this, and I'm going to show you a second version of this using these portfolios I just introduced. So how do we do that? How do we construct hedge portfolios? It's a long trek up this snowfield. This is a family camping trip from a few years ago when we were young and strong. Well, here are two portfolios we're going to look at. One is actually not our portfolio. It's Bob Litterman proposed this stranded asset portfolio, which is basically short a coal ETF and an energy ETF, both U.S. based, although the assets included are not just U.S., and long the S&P 500. This is a portfolio that should benefit from go up when there are a lot of stranded assets, which actually really look like they're going to be stranded, and those are likely to be coal assets, oil assets, and I guess gas fracking assets as well. A second portfolio that I want to talk about today is a factor mimicking portfolio that Jean-Luc Denard, Brian Kelly, and I have put together, which is to form, it's a dynamic long-only portfolio of these publicly available climate funds. What we want to do is we want to minimize the variance of these portfolios and maximize the correlation with climate news. So it's taking out the news information and seeing which of these funds responds to climate news. So we're going to do this monthly. We'll hold the portfolio for the next month, and then we'll recalculate it. So here are the formulas. The yellow box tells you kind of what we're looking for. We're looking for the portfolio weights. The key relationship is the last equation in the green box, which says that the returns on each of these 178 funds depends partly on climate news with some beta and partly on other investment factors. And these are sort of Fama-French style factors. We also include in here the stranded asset portfolio, and we also include in here an oil price factor. So then what we want to do is we want to minimize the variance of this portfolio and maximize its correlation with the estimated betas here. So that's kind of the problem, and we want to do this in a long-only framework because since these are all supposed to be environmental portfolios, it really doesn't make sense to try to be shorting them. And in many cases, they're mutual funds that you can't really short. So there is a statistical issue in how you form a covariance matrix with 178 assets using a short time period of data. And the answer is, well, you have to shrink it, and you have to shrink it a lot. And Gianluca has a new paper on a new type of shrinkage, which is applied in this case. So what do we do? What do we get when we have this? This is now an all out of sample portfolio. In other words, these are each month of this is an out of sample month. And so we put them all together, and you can see that over time it's had a nice appreciation. If you look at the features of this data, of this portfolio, which we think is the key feature, when you regress its return, its out of sample return on the stranded asset, market factor, HML, SMB, and the oil factor, and then you include our news measure, this is a C-tag, which is a measure of what proportion of the news is about climate. You get a positive and significant coefficient. When you take the news output and put a constant term in, you get an alpha. And this alpha is positive and significant. It's about 6% a year. So the secret is we're picking portfolios that are correlated with the news. And that's how we get a positive alpha. So is this really a climate hedge portfolio? I think so, because it's correlated with the news. Is it really dynamic? Yes, because we're re-estimating it on a monthly basis. Is it really a minimum variance portfolio? Yes, but subject to the constraint that it's correlated with the news beta. Is it a physical risk factor? Well, we've already included a stranded asset portfolio factor in here, so maybe this is a physical risk factor. But none of these funds have the word physical in the title, and so there are none of them that are explicitly say they're going to be physical risk measures. On the other hand, physical risk is pretty hard to quantify, and if some manager is actually able to quantify which stocks are most susceptible to physical risk and which ones are not, then that portfolio is likely to outperform, and it will especially outperform when there's climate news, because a lot of the climate news is actually physical risk kinds of news. So we would expect this to be able to select portfolios that have some amount of physical risk in them. Is it really a stranded asset portfolio? Well, if there's a carbon tax, then producer prices and quantities should both fall, but consumer prices should go up because there's a wedge between producer prices and consumer prices. So this is kind of what's going to lead to stranded assets. When instead of that we have regulation, we're reducing the quantity of fossil fuels supplied in some regulatory way, and that may or may not lead to falling prices or profits. It could actually lead to higher profits, and certainly could lead to higher stock prices, both for both producer and consumer prices. And if there are subsidies for renewable energy, such as the Build Back Better kind of Biden plan, then it does seem quite reasonable that that the kind of transition that's being planned there is not the same as the stranded asset portfolio, which would be responding to carbon tax. It's not really clear whether the subsidies for alternative fuels are actually going to lead to more stranded assets or less stranded assets, because many of these companies that have fossil fuel assets are going to be receiving some of these subsidies as well through, building solar facilities and so forth. This portfolio was pretty successful in general, but it was especially successful during the pandemic. It had an alpha of 69% in 2020, which is, pretty amazing. The stranded asset portfolio had an alpha of 30%. So these complement industry research, which says that sustainable funds did very well during the pandemic. But I think the pandemic had a lot of features which look like transition risk in the climate space. I'm going to skip these couple slides. These are the portfolio funds that appear most often in this portfolio over the 20-year period, and these are the average weights in them. Or I guess these are the average weights in them. And at the end of the sample, which in this case was June 21, these are the funds that had the biggest role in there. And as you can see, the top fund in this case was the Boston Common ESG Impact US Equity Fund. And then there's the Vanguard Social Index Fund and so forth. So there are a lot of these funds. It's pretty hard to tell exactly what they're doing, but there are only actually 7 of them that are in this fund. And when you use long-only funds and reduce the variance as much as possible, you actually end up with only a subset, and sometimes even down to just one fund that you're holding at a point in time. So what are we going to do with these factors? Well, we could invest in them directly to achieve a climate hedge performance. The factor mimicking portfolio is investable. The stranded asset portfolio is investable. That's one outcome. We could invest in portfolios that have a high beta on these funds to achieve similar performance. And in VLab now, we have calculated the beta on both of these portfolios for all 178 of these assets to see what their betas are. So this is another way of thinking about what to invest in. We could measure risk and return of the hedge portfolio with GARCH. We could do this to see how volatile are these factor portfolios. And you might want to think that there's some risk in these hedge portfolios. And then finally, you might stress test banks just like you stress test other portfolios for the climate sensitivity. And so we're doing this now for US, UK, and many other banks to calculate capital adequacy for these banks when the stress is a stress of one of these climate factors. So we could do it for the stranded asset portfolio, or we could do it for the factor mimicking portfolio. We could do it for both. And so the idea is, let's do it first of all for the stranded asset portfolio, because that's pretty simple and straightforward function of fossil fuel exposures. And what do we get? So this is now a new paper by Hye-Young Young, Dick Berner, and myself. And what we're going to calculate is the beta on bank stocks from this stranded asset portfolio. And then we'll calculate C risk just as we do S risk by asking whether there's a capital shortfall under if this counterfactual climate factor materializes. So basically, we're going to regress the returns on one of these portfolios, on a market factor and on the climate factor. And we're going to be interested in this climate beta. We're going to estimate these betas with time variation. In this case, we're going to use the dynamic conditional beta model, which takes account of the fact that both correlations and volatilities are changing over time, and see whether these betas are large or small, because that's a way of measuring the exposure of the banks. The stress scenario is designed basically to look at this climate factor, how big it ever was. Did it ever fall more than a certain amount? Well, yes. We look at the 1% point on how much it ever fell over the 6-month period, and that's actually 50%. So 50% is the stress that we're considering at this case. But you could do any other stress if you want. Okay, so here's a picture of the 6-month returns. You know, this is the election schedule in the U.S. The biggest negative returns were just leading into the financial crisis in the U.S. I don't know whether we would expect bigger negative returns in the future or smaller negative returns in the future, but this is a benchmark we're talking about. So this is what the betas look like in the US, and here is 0. So what you see is, if you go across here, the large US banks have betas which are often less than 0 here, which means that the stress isn't really going to impact the banks particularly, but at the end rises quite substantially. So this is kind of consistent with the performance metrics that we were talking about for the climate factor. If you look at the same thing for UK banks, you see 0 is down here, so that they're actually positive pretty much of this whole period since the financial crisis. So, but they also have this pretty consistent rise toward the end. If you look at French banks, you see something kind of similar at the end. If you look at the holdings of the U.S. banks at the end of this period from publicly available information, you can look at the proportion of active gas and oil loans in each of these banks. You see it is positively correlated with the climate beta that we have. So this is a little corroboration of the way we've actually measured this. We're in the process of getting much more granular data on the bank holdings, and this is supervisory data, so it's not in the public domain, but should give us a better way of actually corroborating our statistical estimates. So if we have this kind of a factor, and we're worried about more than one asset risk at the same time, we can actually think about both a market decline and a climate decline at the same time. And how do we do that? Well, with a stress scenario, we've got a beta on the market, we've got a beta on climate. We can impose whatever stress we think happens for each of them on here, and we get an estimate of what's going to happen to bank stocks. It's not exactly the sum of the two, but you can calculate it. And you can calculate how much the market cap of the bank would go down, which would tell you something about the capital shortfall that the bank would feel if these two events were to happen at the same time. And maybe we want 3 events. Maybe we want both climate factors in there. Maybe we want a physical risk factor. Maybe we want other things as well. But this is a way of trying to take account of these joint events. And when you do that, you would come up with countrywide estimates of total capital shortfall, sort of like what we've done for S-risk. Here's Italy. So the red is the total capital shortfall. That is how much capital the Italian banks would need to raise if we have another financial crisis, sort of like the last one. And the blue is how big does it have to be before you get worried about it? And the answer is, well, we're pretty close here at the end of the sample period. But if you put on top of this the climate risk, you're going to push this thing up, and it might actually end up driving you toward a financial crisis that you weren't previously expecting to be serious. So I think it's interesting to do these compound stress tests. It's unclear what the probabilities of an event like that should be, but it's also not clear what the probabilities are from an ordinary stress test either. And so you might like to know whether you're exposed in this way or not. And one of the reasons for doing this, of course, is that this is a generational issue. What kind of a world will my grandchildren inherit? These are three of my grandchildren looking out over a peaceful lake, and they're kind of pessimistic about what we're going to leave for them, and that's a problem. So it's pretty important that we recognize what the issues are, what the risks are, and see if we can do something about it. And if we can, it's going to make them a lot happier. So let me stop at this point.
Thank you, Rob, for a great presentation. And we have a few questions. And one is a clarifying one. So we have one question that asks, could you elaborate the benchmarks that you've used to calculate these betas and the 6% alpha of the climate risk portfolio, just to know what we're comparing this with exactly?
So this is for the factor mimicking portfolio. So we regress the returns of each of these funds on three Fama French factors. These are investable factors, not directly from Ken French's website. They're actually mutual funds which are designed to look like HML and SMB and so forth, and also the stranded asset portfolio, and also a oil price increase. So those are the exogenous, or at least right-hand side variables in this regression. I guess nothing's exogenous really in this in finance. And in addition, we put in the news series. And the news series is calculated from the New York Times, and it's basically what proportion of the articles over the last week were climate related. And the idea is that when there are events like hurricanes and droughts and floods and stuff like that, you're going to see a lot of things which are classified as climate related. When there's a meeting like COP26, we've just been inundated by that. This will be a big number, and you might expect that at those times that you would have positive returns on the portfolios that are the most effective green portfolios.
Okay. Thank you. And then, so more broadly, there's a question on what's your view on passive investment into decarbonized indices? Index providers are launching them. Do you think there's an alternative to the kind of strategies that you're suggesting in your talk?
Well, that's what many of these portfolios are already. They're decarbonized funds using some measure of ESG. It's one of the ways to use ESG, but it's by no means a unique and only way to use ESG measures. And so I think what we're hoping to see is, when is something like a decarbonized index fund, when does that outperform? Does it outperform when we have information about climate change, or what are the events that make that a good strategy? Because it's not the only strategy we have. We've got batteries, we've got clean water, we've got these fossil fuel free funds and so forth. So there are a lot of different strategies. It's easy to complain about the ESG data. So different fund managers have used preferably different kinds of ESG metrics. Different vendors are making one better than the other. The thing that we would love to know is exactly what's the fund manager doing when we put his fund in the market. Does that tell us something about what's the best way to manage a sustainable portfolio? And the answer, I think, is, at least so far, we don't think we can ask the right questions to get the answer to that. But if there were always one fund in the top of these markets, it would be pretty interesting, and we would definitely want to know what's he doing.
Yeah. And now we have a question that goes a little bit outside, I think, what you were talking about. And the question is whether you've considered the risk of climate debt, because the follow-up cost of CO2 emissions could be as high as about 700 euros a ton for the next 100 years. Global emissions are 38 gigatons. Okay, and that implies that we build up a climate debt of about 26 trillion euros.
Well, I don't know exactly what policy you're thinking about with that, but it means if you think that the right carbon tax is 700 euros a ton, which is higher than I've heard other people say, you have to ask what happens to that money. I mean, okay, so companies have to pay all that money, but where's that money going? Maybe you could drop all your income taxes to zero, and there'd be this would be a real boon for consumers, or redistribute it to poor families, and then all of a sudden the income distribution could be inverted. I mean, when you talk about these things, we're really relative prices. What we're trying to change, we're trying to change relative prices to reflect the externalities that are in this market. It's not just sucking money out of the economy. Now, it is true that if we don't do anything, we think that the climate is going to increase costs and suck up money that we're not currently spending, but we think that we can reduce that amount of damage by changing relative prices along the way.
Yeah. And just one last question, Bob, and that is, I'm trying to think of the people who would be interested in taking one side or the other of your sort of factor mimicking portfolio, because
Right.
maybe many people who would maybe be very interested in trying to hedge climate risk, and then who are the people who are responsibly on the other side and willing to take climate risk? Do you think there's likely to be a large divergence across responsible investors for the kind of positions they'd want to take on this?
I think so. I mean, because this negative risk premium that this portfolio should have, at least in the absence of new news, is supposed to be the compensation that the investor in brown assets will expect. And certainly, we're seeing a dramatic rebirth in energy stocks this year, and I think part of that is people are pouring into them because they do have higher returns, because they've been beaten up by being brown, and so that they look more attractive. So, I mean, I think this is an equilibrium. and it's an equilibrium where the risk premiums are just enough to encourage people to take, people who are not so interested in climate or don't mind taking climate risk, hold one side, and then other people are on the other side. So it's an equilibrium, and then when there's new information, it changes the equilibrium. And so we can't forecast what the new information is going to be, but when it comes, it changes, it reprices the assets.
Thank you, Rob. You've given us an awful lot to think about today. Thank you very much for that, and I'm really glad you were able to join us. Thank you.